Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Thank you, intro man. Gosh, we're so professional now, guys. Let me tell you. We're trying to level up this podcast a bit, or I shouldn't say podcast. It's a show. It's a video show, but we will have a podcast version up and running. We're starting to kind of go through some of our old episodes. You know, there's a lot of you out there who want that audio version only. Oh gosh, I realized the intro is on a loop. My bad there. I know there's a lot of you guys who want an audio version of the podcast, so we're going to have that coming out over the next few really months as we kind of go through all the old shows and put them in audio form. And we'll have an official podcast version of the show up and running very soon. So stay tuned for that. Otherwise, we'll continue doing video versions. We're actually streaming this one on Twitch for the first time as well. So if you're on Twitch, welcome to Punch Card Investing. But we're trying to kind of expand our reach as we continue to grow the show. And we've appreciated all your guys' support along the ride, just trying to do things to improve the show as we move forward. With that said, like, comment, subscribe, all that great stuff. Check out the stuff in the description below. Links to Share Site and to Seeking Alpha. You get discounts there. And also to our Discord. That is free, the Discord. Go ahead and join that. And you can join the group. So, all right. Where do we want to start? Should we just talk about our portfolios in a kind of the lead up to 13F week next week? We can do sort of a amateur 13F week where we talk about our own portfolios, maybe something like that. I know there was some recent news with SRG with kind of their sell down. So maybe we can start there. Tom, you're an SRG shareholder. I'm going to pass it to you right away.
Yeah, we got a super chat for the Punch Card Conference Fund as well.
Early super chat from Matt. Thank you very much. I think he did the same last week. He's getting our Punch Card Conference Fund going. We appreciate that. Tentatively something during the Berkshire meeting next year probably would be nice.
It'll be fun. Like Punch Card with Charlie.
Yeah,
I think Charlie would come along.
I think Tom could hook that up by
now. Should we do Seritage?
Yeah.
Yeah. Okay. So Seritage had earnings come out this week. They report a few elements of kind of what's going on with the business, obviously, with their earnings. So if we were looking at this a few quarters or a couple of years ago, we might have been looking quite closely at the new leases and NOI data and that sort of thing coming out of Seritage. They still report those numbers, but obviously the story's changed a little bit to where it's really turning into more of a liquidation kind of approach now. So it was interesting to kind of see what's happening with that. So it seems like property sales are speeding up quite a bit. We had 163 million in proceeds generated from property sales in the second quarter. They also gave us a little bit more information on top of what happened in the quarter they were reporting on. So they said an additional 102 million has been generated subsequent to Q2 ending, and they are either under contract. Yeah, they're under contract, for a further 260 million, and they have about 1.2 billion in real estate currently on the market.
Tom, are you, and I guess who else is in Seritage? Karan, are you?
I am. Yeah.
Jack, are you in Seritage?
No, but I'm getting more tempted actually, as even though the potential for profits kind of lowering as we move forward, the risk is lowering as well.
A little more certain, yeah.
Yeah.
Tom and Karan, are you guys happy as shareholders with the communication you're receiving?
I think increasingly happy with what's coming out of Seritage. Yeah, a year or even going back 12 months, Seritage was so much of a black box, and we now get kind of every individual property listed out, which is really nice. They gave us a Q2 financial supplement document, which gives us that updated property list this quarter, and it has the list of the exact properties that have been sold and that sort of thing. So, yeah.
Yeah, a lot more disclosures compared to when Benjamin Shaw was like in charge.
Mm-hmm.
Yep.
And are we at a point now where you guys feel good about the debt situation and it's safe to say they're not going bankrupt and they're going to crystallize $15 to $30 of real estate value? Is that something people should be able to say now, or is it still kind of up in the air?
Well, it's going to be a couple-year project, I think, to get this thing fully liquidated. I forget the exact date ranges they gave, but it was something like 1.5 to
months,
3
I think.
years, something like that. Yeah.
And the $29 a share or something like that.
Yeah, 1850 to 29 is
1850
the
to
range
29.
that they've given. Yeah, and they didn't give any update on that range in this quarterly filing, as far as I can tell. I guess the other thing we should mention is they did pay down a little bit of debt. I think that news came out the day before their earnings release. They paid down 100 million in their loan to Berkshire, which leaves about 1.34 billion, I think it is. So there's still about 540 million that'll be due by July next year. So they've still got, quite a bit of real estate to sell to meet that one.
Interesting.
When did they defer the other 800 million to? Is it like 24 or is it
25? So they'll have another
25.
2 years after that.
Okay.
First 800 million is due. So it was 800 and 800, but
I'd like to
they've paid
borrow
off
some
the
money from
first chunk.
Berkshire. Very, very friendly lender, it seems like.
Well, you got to pay up for
7% is like, bleeding out the company.
I'm paying Citibank right now 9% for a flex loan, so I can buy Activision Blizzard and make 26%. So I'd pay 7%. Yeah.
I don't know that I'd ever want to be on the other side of a deal from Warren Buffett, personally.
Jack, have they not been pretty friendly lenders? Like, couldn't have someone just pretty much taken all the Seritage real estate at some point if they wanted to, when they had issues?
They didn't default, did they?
Didn't Berkshire extend their debt, or they were
Yeah,
very
they might.
friendly?
They might have, but I mean,
Yeah.
foreclosure's it's a messy process for both sides. So if you really wanted to play hardball, it's not like. First off, that would have taken a while for the portfolio this size. So I don't know. They haven't had much of a chance to do anything sharkish yet. So yeah.
I'd love to ask you guys a question. Maybe I'd love you to really give me the truth here, and make me feel like a good investor or a not so smart investor. But just recently, like at the end of June, so a month and a half ago, the price of Seritage was at like $5.29, and I didn't buy it. And I obviously tracked the price often, so I knew where it was at. And the reason I did not buy it is because even though I knew there was maybe $15 of real estate to $30 of real estate value, net asset value, I kind of got worried about their ability to actually make that happen. And then I got worried about the debt, and then all the macro things that could happen in the interim to kind of mess up their plan. And I was thinking well, if it's just a $5 or $6 a share and it goes to $12 or $15 a share, that's not worth that risk. So do you think that's valid, or do you think I just totally missed it and it really wasn't that risky looking back?
Well, wasn't that right around the time? Was that right around the time you would have jumped into Carvana?
Yeah, I was looking at different kind of things.
Time.
Yeah.
So you kind of have that
super chat.
You kind of have that mix in. Oh,
is that a world record super chat?
That's a pretty fat one right there. Thank you, KK Investing. Adding to our punch card conference fund. Yeah, that's what we should say. Super chats don't give you a question; they just go straight into the conference fund. So if you want that,
yeah, that's a good one. I like
we'd
that.
Appreciate that. Then maybe we could bring out a pro speaker too, if the fund got big enough. No promises, but thank you, KK, a loyal supporter of the channel.
Well, I don't know. Do you guys think I missed the $5 to $14 run up in like a month, or do you think it really is somewhat of a risky investment?
Well, I the reason I asked about Carvana is because the sort of zero or hero thesis it's similar. I mean, vaguely similar in that your downside was high with both if they didn't make it because of all the debt concerns. And
well, that's why I'm in Carvana instead of Seritage, because with Seritage I was like it goes up 2 or 3 times, big bump, right. But with Carvana it could go up 30 to 50 to 100 times. And then you put in a few more factors. I just say this because it makes people mad. 150 times. But there's a lot more upside is my point. 200 times, yeah. You never know, 300 times. But there was more upside. So I don't know. But now that I'm looking at Seritage and all you guys tweeting about it every single day because you're so happy because you're back to even, I'm wondering if I missed it at $5. So was it a big miss?
I've seen a lot of tweets, people saying I missed it at $5. It's like, I think you've got good company there. Like,
Yeah, I think it's a different equation. Like before, it was trying to get a portfolio of fully developed, leased out real estate. Now it's a liquidation. So that discount to liquidation value becomes much more of a real thing.
Much more
than it
real,
was
yeah.
Before, yeah. So I mean, I did the exact same thing as you. If that's any consolation, Jason.
And you owned the stock during the time, yeah.
Yeah. I mean, it's it's a nice kind of concept to always average down on ideas that you like, but you got to stop at a certain point. Like we're not immune to making mistakes, and you don't want to have half the portfolio in it. So
the one thing I'll say is it does show the value of buying something with a big margin of safety, because the whole Seritage thing of the crown jewels and we'll turn it into apartment buildings and we'll get 10 times the rent because they'll have many stories and all that. I guess it's not happening, but it's not likely that you guys are losing money because the value was there the whole time. Margin of safety.
That's really the key part of the thesis anyways. It was the liquidation, like sort of backstop. And then the sort of like, dare I call it a pipe dream of just having some like monster properties carry the portfolio was like your potential excess return on top of that backstop. And then of course you had to weigh the debt risk however you wanted to weigh that. But it seemed like the liquidation value per Tom, you did a lot of backbreaking research into all the properties and it was to that more so I'd say than the redevelopment plan, unless I'm mistaken there.
I see a comment, Lampert the Liquidator from Hodo Prime. Is that a risk that you guys fear at this point of not him, but someone or anyone coming in and buying the company? I guess it's at 14 now for like 18 and not getting your $25 to $29 a share, or has that ship sailed?
I think that's something that's unknowable. Like,
yeah.
So
that's my problem with Seritage. There's so many. It felt like there were so many unknowns the whole time.
Yeah, but again, same thing goes back to like anyone who regrets not buying at 5. It's like you didn't miss it. You just exercised prudence at that point. And
I guess I decided not to buy it. Is the truth.
Yeah, and same goes with selling it. Like if it makes sense to you, sell it. If it doesn't, then don't sell it or don't even get into it. Like, yeah. If you have to ask, then better to skip it.
Quran dropping wisdom.
Yeah, it seems like probably the most valuable assets in Seritage's portfolio are probably the most liquid. So I think the chances of Eddie Lampert sweeping one of those up at some super low price isn't super high, but we'll see.
I'd love if Guy Spear goes back on your podcast, Tom, in the future, which I'm sure he will, for round 3. If maybe he'll talk about Seritage at that point, if it's out of his portfolio. I'd love to hear how he was thinking about it the whole time.
I feel bad for Monish selling it like just 2 months back. I wish he held on.
For his own sake.
For his own sake, for his investors.
He's probably looking at stuff he's thinking is way cheaper in Turkey or something.
Maybe.
Yeah,
one person.
It's a double in 2 months. Just held on for like 6 months more.
Yeah, but you never know when that sort of sudden change is, change in management's going to kind of turn up.
Fair.
Yeah. The other thing I was going to say, I'm not sure if you guys caught the latest Matt Peterson podcast, but it seems like he bought a fair bit of it somewhere down there, mainly because he was getting forced to from all the puts he wrote. So I don't know how close he got to that $5 mark, but I think after the price run up, it's like a 30% position for him now in the fund. So
wow,
it's pretty serious.
Was this the podcast where he talked about Turkey? Because I retweeted something and I haven't listened to it yet. That's what I did.
That's like just reading the title of an article and sharing it.
Yeah.
Good way to know a little bit know nothing about everything. Headlines.
Tom, he manages like around 20-30 million, right? Or so?
Yeah, I think closer to 30. Maybe it's a little higher
So
now.
it would have been like a 9 million position. Assume like it would have been around that much, right? So it would have been at least a significant portion of the company's assets, like total shareholding. He would have been like at least a 1% holder, I think.
Yeah, I know he was definitely above 0.5%. I think I've heard him say that before, but I don't know what it got up to. Yeah, I think he's a 1% shareholder of Daily Journal now.
0.5. As far as I know.
Yeah,
I
0.5.
think it's 1.
No, I think it's 0.5.
Oh, it's gone up? Okay. I didn't know that.
Okay.
Well, he said 1% in that podcast the other day for Daily Journal.
I'm just kidding.
Okay.
Round up.
Yeah, round up.
Yeah, round up.
Anyway, that's where Seritage is at.
So what are you guys going to do? Are you just going to hold and hold till let the story play out? Let the liquidation process happen?
What are you doing, Karan?
I'm selling out at like 1920. I'm out. Yeah, I'm fine with not taking the upside. It's okay.
Options?
Yeah.
Buying more options?
Nothing. Just literally selling out existing shares.
Just
done.
okay.
You don't want the
Move
money
on.
tied up there anymore for the opportunity cost issue?
No, I've got something else I'm interested in. So
What's that?
You'll probably see it next month. You'll see it in the update video. So
Okay.
Secret?
I'm going to publish it on YouTube later. So
Temporary secret.
temporary secret.
Carvana.
He doesn't want to front run himself. He's still building out that position. He's got a huge fund to move, doesn't want to move the markets.
Yeah. What about you, Tom? Are you selling or?
Yeah, I don't have a home for the cash at the moment, to be honest. So I'm just hanging on. I've been thinking about it more and more, though. I'm not entirely sure how to think about where you might sell something like that. I kind of, in my head, I keep making comparisons to the Activision sort of, arbitrage that Buffett's doing, where it seems like he wants sort of a roughly 20% premium to make that deal work for him. So maybe if we get within 20% of the midpoint of what they've put out there, I'll reconsider. I don't really know. That's sort of how I'm starting to think about it, though.
Makes sense.
Jason, are you considering diving in at all?
Not at this price. I don't think. I guess you could. Well, I guess you could argue at the most that you're looking at about a double. But I just, for all the reasons that have kind of held me out of it, I'm not interested. But I think if there's something that happens with macro and it goes back down to 9, 8, 7, something like that, I'd at least be more open to being interested, because I did buy it when it went down to 10, like the first time it dipped a while ago, and then I sold it at like 12 or 13 to do something else. But what I liked when I bought it at 10 was that new CFO got hired, and he's the guy that's also liquidating the Luby's real estate. And once they brought him in, I was like, oh, okay. Like, even before they announced it, I was like, I know this will happen. They're going to start liquidating because that's what that guy does. And so I like that there was movement in a plan that we could actually see. So I like that. I guess it's so dependent on what else is out there at the time. But I am keeping my eye on it price wise. And if it drops a lot, I'll look at it. But I'd be surprised if it did at this point, given how high the conviction is of current shareholders.
Yeah,
fair enough.
The other thing probably worth mentioning just quickly with Seritage is they did give an update on the whole Sears lawsuit that's been hanging over them for years and years and years at this point. So they seem to have arrived on a potential settlement agreement, subject to court approval. So if you look at their balance sheet on their latest quarterly update, they've got I forget the exact term, but some sort of like settlement reserve as like a liability on their balance sheet of 35 million, I think. So that's a lot lower than some people thought it might be. Yeah, I guess those things are always kind of unknown, but again, a little more certainty possibly coming soon with that one.
A lot of people are wondering about shorting Seritage. Do you guys have any thoughts on that?
I will never short.
No, but I mean, not you, but like as a concept.
Oh, well, my initial thought is, how could you short Seritage at this point? Because it seems so likely they're going to quickly liquidate real estate and give you more than the current price per share. I think
the way Tom put it is kind of right. Like, you think about it as an arbitrage. Like, the price at what eventually it will sell out at.
I could see it if you're potentially like for portfolio construction, you want like a hedge on the real estate industry or something. I could see something like that. But yeah, just straight up, shorting's already like a rough concept as it is, because at most you're getting a double unless you're like leveraging it further, but good luck with that. And your downside is technically unlimited, although it's probably not as unlimited with something like a Seritage, because if they're liquidating, they can't go up forever, right? At least one would think.
Unless it becomes a meme stock or something.
Yeah, short squeeze.
Yeah. What else been happening in people's portfolios that are worth talking about?
Jack, I saw Turtle Beach had earnings this week. I was looking at the newspaper
earnings
this week. I saw that and I thought of you. What? No, it sounds like it didn't go good based on what you guys are saying. Okay.
I was filming my video for Monday, and I talked about Turtle Beach mostly. They plummeted like 30% on the earnings call. They've jumped up again like 10%, or 7 or 8% today. But basically they announced that first off, they're losing money because they're selling all their overpriced inventory that they're trying to move. And then they also announced, I think more importantly for the share price, that they're not trying to get acquired anytime soon. So that scared a lot of people away, I guess.
Wow,
And yeah, but the main topic for my video for Monday was talking about cyclicals, because it's really what Turtle Beach is. And I like knew that going into the investment, but I definitely did not respect that fact as much. I was thinking that they were going to rotate. So basically they have a lot of their cyclical console headset sales that make up a large portion of the revenue, and that's crushing. Or that not crushing, but that's falling. And then they're pivoting a lot of their sales towards PC accessories, which is what I was banking on. And that so far, that part of the thesis is going okay, but I didn't realize how much weight I should have been putting on the cyclicality of it. Because as soon as you see sort of negative, a fall in sales, investors get scared naturally. And also you kind of had a lot of demand pulled forward in 2020 when I started investing, and into 2021 from kind of the lockdown and all that. And that's showing now that demand is slowing a bit. And that has people concerned, as it should, because, you hate to see shrinkage in anything, but I'm still holding the stock long-term. I did add a little bit recently, but yeah, the earnings were not pretty in the short run.
Interesting.
How do you think about trying to sort of normalize earnings from something like Turtle Beach, Jack?
So when I went in here, I'll actually pull up the ticker for it. When I went into the stock, I wasn't assuming that they were going to maintain their 2020 numbers, but just kind of to give you an idea of what I was thinking. And still kind of thinking, but go over here to ticker and into the cash flow statement. I absolutely love that ticker has an actual free cash flow line now. You don't have to do the cash from operations, capital expenditures thing now, which is just tremendous. But here's kind of their free cash flow over time. And this year, last 12 months, it's like negative 50 million, which is like double what it was in 2015. That's kind of that demand being pulled forward, the result of that. Because you can see the spike here in 2020 in free cash flow, and the revenues were way up too. Let me pull that up too. If it loads, you can see the revenue right alongside it, and you can see the kind of the cyclicality, the little wave formation here over the years, and it's spiking really hard in 2020, still remaining quite high revenue wise in 2021, and it's they're projecting something like 250 for 2022, which is still high historically speaking for revenues, but their costs are also higher because they tried to front load a lot of inventory with all the supply chain issues and all the demand, and they're paying for that now. So the good part is they still don't have debt, so that protects your downside at least to some extent. But obviously, you're investing in a business for a future cash flow stream, and if cash flows aren't going to be thick, that's cause for concern. So yeah.
So I guess the question here, Jack, for you and for the punch card portfolio, in fact, as well. But I guess we've got to find something else interesting before we boot one out. I mean, it's was that a sneaky Carvana? I heard Jason.
It just came out. I'd love to see you guys put that in
happens. There. It's like a reflex.
But you were asking Tom about how I was thinking about it. I realized I didn't really answer. But
I was going to say, like, it sounds like obviously this, I guess if we want to call this a down cycle that they're currently in or heading into.
Yeah, it's fair to call it that.
Sounds like you might have underestimated that going in potentially, but does it change what you think the long run normalized earnings are? Or like, are you more negative now on a normalized number out of Turtle Beach moving forward, or still pretty similar?
I'm definitely a bit more negative than I would have been like a year and a half ago. I'm not overall negative, because I mean they're trading at like 150 million market cap right now, and if they can bring their historical cash flow in like a decent cycle, is you can see right here around 37 million in 2018, 37 million in 2019, in a really good year, 45 million in 2020. They're also acquiring companies as they're going through this. And then kind of their negative years, they're as low as negative 20-ish back in 2014, 15. And this year they're negative 50, kind of getting rid of that expensive inventory. So if they can get back up to that, even like $25 million annual free cash flow on a $150 million market cap, I mean, that's nothing to scoff at. So that's kind of what I'm thinking long term. I don't see them going under, and there is still a chance that they get acquired, of course. So that's kind of how I'm thinking of that. I was guessing like normalized sort of free cash flow would probably be closer to that 30 million mark. I didn't expect such a sharp drop because they definitely brought on a ton of expensive inventory that definitely was underestimating.
Yeah, we've got what I think is a big super chat. I've just Googled it, and it's about. Oh no, it's gone to New Zealand dollars. Hang on.
Reconvert.
Yeah.
But Aaron, with 30, is that more Malaysian?
Malaysian
ringgit, right?
Yeah.
Ringgit.
We get a lot of Malaysian donations, which we very much appreciate. We appreciate all currency donations because it eventually gets converted by YouTube anyways. But
I believe that's $6.75 US.
Well, thank you very much, Aaron. He says, collectively, you guys have helped me improve as an investor over the past year. Aaron, you have improved yourself. We're just here to talk about whatever you guys want to get out of it. Great. But you're taking initiative in your own situation, and that's why you're a better investor. So, but regardless, thank you for all your support, Aaron, and everyone's support.
Jack, you should be a motivational speaker. That really got me.
That was good.
Yeah. I should charge for that. Hey, give me another super chat, and I'll make more people feel good.
It's like Cameo. He'll pump you up.
Oh gosh. Yeah. I need some motivation after the Turtle Beach earnings, but
Jason, I want to hear what you've been doing. What's been happening in your portfolio?
What have you been up to?
Honestly, I've been trying to keep my ego in check, and I'm not even kidding about that. Like, I look at my portfolio, it's up a lot. Yeah, I'm up like 70% in the after dinner investor portfolio, but personally I kept buying Carvana when it was down a little more, and I'm up 90% or 91% in like, I don't know, a month or something, and I don't swing small, so it was a big nice big chunky bet there. So that's going good, but everyone kind of knows that story. Got a couple interesting things. I guess maybe later if you guys want to talk, we can talk a little process, because Rob Vinall put out his letter, and there's a little nugget in there that's interesting. But Coupang put out their earnings yesterday, and it's like a 4 or 5% position in my after dinner investor portfolio, and I actually sold it personally because it was a mistake, but I got a little bored with it and decided to do other things with the money. And the reason I got a little bored is because I never really understood the investment fully. It was just a pure shameless clone of David Abrams, And I watched him buy in 2021, I think it was, as the price dropped, and I was able to buy it at a lower price than him. And today I finally figured out the business or the investment. And in their earnings transcript, Bom Kim, the CEO and founder, he talked about how Coupang, it basically it's the Amazon. He didn't say this, but I'm saying it's basically the Amazon of South Korea, e-commerce. South Korea is growing. In their transcript, they said, and if by 2025, they should be the third largest e-commerce market in the world. And Coupang's market share, I don't know what it is right now. I need to find that out, but it's small, is what they said on the earnings call. And they're taking market share. They're growing faster than the market, and they're taking market share. And if you look at their offerings and the price differentials of what they sell to competitors and what they offer with their services and all that, it's like obvious that they're going to keep growing. And he said that by 2025, the e-commerce market in South Korea should be 290 billion. I think it's growing at about 6% a year. And if Coupang at some point gets up to 40% market share of 290 billion, and I don't see why they wouldn't, that's 116 billion. If they sell 116 billion in sales, 40 billion or 40% of the 290 billion e-commerce market. And right now, I think they're selling for a price of sales of like 1.3 or something like that, 1.3 to 2. And let's just say they sell for a price to sales of 1. That's $116 billion market cap. And today they're like a $33 billion market cap. They have net cash. And I have that shameless clone aspect going to it as well. So I finally kind of figured out the investment, and I'm motivated to dig into it even more and probably buy more because I have a destination analysis, as the saying goes. And so I figured that out today. So I thought that was pretty interesting and pretty motivating too, because a lot of room for growth. And by the way, just how small they are, like I think they're selling for 2 times. I think their revenue is like 16 billion. And if the market in 3 years is 290 billion, 16 divided by 290, I think that's less than 10% of the market potentially, or around that. So long way to go. And I think they're going to keep taking that market share.
Jason, is David Abrams still in Coupang? That's where you got the idea from, right?
Yeah, that's where I got the idea fully from. I think if you look at, yes, he's still in it. And I think if you look at his 13F, but then if you look at the assets under management, and then you consider that he bought Coupang initially at a much higher price, my estimate is that it was about a 6 to 7% bet. And he continued buying in 2021 as the price came down. And it says it's like 3-something% of his 13F. That's smaller because of assets under management, because a lot of his assets are outside the 13F. But that's probably where I'm going to keep it to, around a 6 or 7% bet for now, at least.
Cool. Nice. And I guess David Abrams, for anyone that doesn't know, used to work under Seth Klarman, I think, right?
Yeah. If you look up David Abrams Wall Street Journal, there's a good profile of him. And if you search David Abrams on the podcast store or app in Apple, there's a Columbia Business School value investing podcast he was on, and got to kind of know him through that. I know, like a lot of people, when I say the Amazon of South Korea, they say Amazon without cloud, without Amazon Web Services. And I think that's true. But at the same time, Coupang has a couple other interesting things going for it. Just like Amazon, they do a third-party logistics and fulfillment service for third-party sellers. And so I think that should be profitable. And then I think at some point, if they're not already, there will be an advertising business, just like Amazon has. And then they do have some international things going on at a very, very small level right now. But that could also be a huge runway as well.
So Jason, are they like funding their logistics themselves, like in-house, or is that also through acquisitions?
Their thing is, you know how like Alibaba is like advertising and other people sell on their side, and then JD is more like
Right.
or what Amazon was initially. My impression is that Coupang is all about doing stuff in-house. Like they still have third-party sellers and fulfillment and all that, but I think they have third-party sellers, but their business, they are like extremely investment heavy, like extremely. And in my opinion, they're building out a moat because what they're able to offer customers, like dawn delivery, fresh and non-fresh delivered together, next day delivery, or same day, and also for their members, there's like no, I don't know if this is for members or not, but there's no shipping cost over $11 orders once it's over 11. And then also for their like Rocket members or whatever their membership is, they can put out their deliveries outside their front door, not their delivery, sorry, their returns, with no boxes, nothing, and they just leave them on their doorstep, and Coupang will pick them up. And so everything I know about it just screams that it's going to keep growing. And I like the CEO, and yeah.
How are they funding it? Is it through debt? Is it through cash flow?
I was going to ask the same thing, because I just see shares outstanding. I don't even know if this is right, because this number is so ridiculous on Ticker, but apparently shares outstanding grew 4,800% last year. So it sounds like that's how they're funding it.
I don't know. That would surprise me if it was that much, but
it's got 49% the year before that. So I don't know.
Yeah, I don't know. I don't know how they're funding it. I have to do more research and figure it out. But just like how Amazon was able to do whatever they did without showing a profit early on, I think the same thing is going on. I know it doesn't seem like it's through debt, because they don't have a lot of debt, and they have more cash than they have debt, and their capital leases, or their lease obligations, I should say, combined. So they have net cash, and I don't know how they're doing it, but they're pouring a lot of money into investment.
It's a huge question mark.
Yeah. I think that's probably worth some digging.
Yeah. Shameless cloner, I'll get around to it at some point, but I am curious. I'm curious to learn more about it. Yeah.
We got another super chat.
We're killing it with the super chats today.
Yeah, we'll toss it back to Tom. Why was Naked Wines a pass from you? Super chat from Nishant.
Yeah, I prefer to drink wine with clothes on.
Tom.
I'm just well, I'm not kidding. Jeez. Okay. Why did I pass on Naked Wines? I just couldn't figure out the competition, basically. I really couldn't figure out why another company with enough money couldn't just clone that exact model, or why a Costco or someone couldn't do the same thing. That's what I really struggled with Naked Wines. And I haven't looked super closely into it just the past couple of months or so, but I think there was a pretty serious going concern issue, and some worries that they were going to run out of money as well. That happened after I was looking into it and decided to pass, but that wasn't even the reason I passed. So not sure what's going on there as well.
By the way, on Coupang, I just want to point out, at a gross profit level at the core, as they say at Prosus, they are profitable with their e-commerce business, and those profit margins are growing. So I don't know how much that has to do with they can then take money and invest it. But I know at the core for their main business, they're profitable.
And what sort of numbers are we talking? Like, how profitable? What are their gross margins like?
I don't know off the top of my head. Yeah, but what I like is I like the cloning aspect of it. I like the net cash, and I like that I can see the runway now. And when I'm more focused on their business quality versus like their competitors, or at least with them. And they just seem, people are saying there is no other Amazon or whatever. Well, I could say there's no other Coupang. Like, some of their offerings, they make me wish I had Coupang in my country, So I'm very bullish on them from what I know. And but again, I sold most of my holdings in it. It's just finally figuring out the runway kind of has motivated me to dig back in.
I wonder if anyone else in the chat is invested in Coupang.
Someone was asking about it earlier, and anytime I talked about it, people seem like they are familiar with it. Some people are.
Yeah, it's growing really fast.
Really fast. Yeah, I think like the revenue was like 16 billion, then 11 billion the year before that, and then 2 years ago it was 5 billion. And someone's saying the massive increase in shares was the IPO or something like that.
Yeah.
Okay.
Interesting.
Karan?
Tom,
Let me say
adding
one
into
final
something?
thing about Coupang is their stock price is very volatile. Recently it was down at like $11-12 a share, and there's a lot of people that seem to be involved in that stock that maybe sell it for reasons that don't have to do so much with the business. So it's something where I'm keeping my eye on it closely, because you never know what could happen. People could get upset in a macro sense, and then Coupang just kind of drops down with everything else, even though the business is improving. So could be a big opportunity at any time. So I'm keeping my eye on it to buy more.
Nice.
Exactly.
Just on the shares outstanding thing, it seems like even in the last 12 months, shares outstanding are up 25%. So that would be something to keep an eye on. And I wonder, with the stock down so much, whether that's sort of, it's kind of like a double whammy bad thing if they keep raising money at lower stock prices. But it's interesting. There's a lot
How
of
long is
smart
that,
people on
Tom?
it. Sorry?
How long did you say?
That's between, well, in the last, I'm just looking on Ticker here, but it's got last 12 months shares outstanding at 1757, and that was at 1423 at the end of December. So I guess in the last
Yeah, and
8
I
months.
can see on their own statement of operations from their earnings statement, right directly from their filing, weighted shares 6 months ended June 30th, 2020. One looks like 1.7 billion, and then a year ago on 2021, 1 billion. So yeah, 70% or so about increase. But I know that's like, the value investing world, people don't like when shares are share count is going up, and they like buybacks and all that. And in some cases I do, but shares count increasing, it really doesn't bother me at all just on its own. I just judge each situation by itself. And it's like with a Carvana or with a Coupang, if the goal is to like continue growing, so one day we have a huge moat and make tons of money, and if that's the way to do it, I'm fine with that, And I don't know, I'm more open to it than I think a lot of value investors are.
Yeah, but there's a reason for that, because growth in a competitive space actually destroys value in the long term. Because if you keep investing into growing a moat where you're never going to be an oligopoly or potentially a monopoly, eventually it's not going to end well, right? At least that's my thinking.
Yeah,
well, you can grow big enough where you have a business model. At least that's the plan with Carvana. They have to grow to be profitable, and then something like Amazon, you can grow until you're big enough where you can have these spawner businesses inside of it, like advertising and third-party platform and all that kind of stuff.
Yeah, if anyone wants to read about the whole issuing shares and share buybacks and when it does and doesn't make sense, I think it's called The Outsiders by William. Is that by William Thorndike? Yeah, is really good. And there's a chapter in there, I think it's even the first chapter, on Henry Singleton, and I think Frank's spoken about that on Punch Cut here before. And Henry Singleton, I should try and find the actual numbers because it's just insane. But basically, if he could, if his stock was selling at, say, 15 times earnings in the public market, and he could buy a private business at 8 times earnings, he'd issue shares to do it. And when private businesses, got more expensive, or his stock got cheaper, and that equation changed, he bought back like 90% of his shares, like completely switched gears. So it can make sense. Yeah.
That was episode. Oh, what was it? It was great. Episode 7.
Early, I think.
Great managers and capital allocators, if I'm not mistaken.
Yeah.
Wow, that was long ago. I felt like it was more recent than that, but apparently it was one of our first few episodes. We're on 63 or something like that today. 63 episodes later.
Another example of this is Ring Energy just bought another company's assets to expand, and in that case, half the purchase price was with cash that's funded by debt, and then the other half is with equity. And the whole time leading up to this, the CEO was like, look, I'm not going to do an acquisition unless it's accretive to the existing shareholders. Like I promised you guys that. And he lived up to his word. He, quote unquote, diluted the share count, but what we got is more assets than debt. And so basically what ended up happening is, even though there's now more debt on the company, it's actually a safer company, because combined with this company we bought, Stronghold's assets, the asset to debt ratio and the free cash flow to debt expense and all that, everything is improved, and we're in a better situation. And like what it means, like on a net asset value for existing shareholders, that previously existing shareholders, it's a good thing, even though it's more shares. So I think it's just a situation by situation thing.
Should we get an update from Karan and then maybe get some questions? We haven't done like a dedicated question section in some time, so probably be good to get something like that, right? Karan?
Updates regarding the portfolio. Not much going on, just new addition. That's pretty much it.
Not much, just something.
Not much, just a new 50% bet.
Maybe this is public in your videos, but what kind of weighting did you have with Warner Brothers Discovery? Was it like a big position, small?
Right. So Warner Brothers Discovery, like before the spin-off, it was a 20% position.
Wow. When
they announced how they're doing the spin-off, it dropped to like almost 9%. I sold half. And then I've been buying over the last 3 months. So
I was in Discovery before, and I think leading up to, and maybe even at the announcement of the whole Warner Media thing. Were you surprised with how negative the market was on that spinoff situation? Because my thought was the whole time was like, as soon as we do the merger or something, the market's going to very much like that, because that was the whole end game the whole time. Were you surprised by the reaction?
It's literally how it's written out in the book, like Joel Greenblatt's book. It played out exactly like that. So not surprised at all.
Oh, that you weren't surprised that the market was negative on it?
No, that's why I sold off half the position, and I've been buying over the last 3-4 months. Yeah.
And what's in his book? Why did you expect the market to be negative?
Because again, like the people who are receiving the shares want dividends, so they're obviously going to be selling off the Discovery shares which don't pay a dividend.
Gotcha.
So indiscriminate selling by institutional people.
Yeah, by the former or the AT&T side of things.
Yeah. I didn't expect it to get down to like 12, which was, I think, the lowest cost basis I have is like 12.85 on one of the tranches. So like, I didn't expect to get that low, but yeah. I don't think we're going to see the results of like this entire plan in 24. Nothing before that. Like if anyone's buying leaps, go for June 24. Nothing earlier.
Yeah. I got to say, I don't know where you all stand on the streaming business model, but like, the whole inflation thing, for my household, it was a good time to kind of look at our budget and see where all the money was going. And I made a decision, like we're done with streaming right now. And we kept a couple of them, like Amazon Prime and Disney Plus, but and the Disney bundle, but the rest of them we cut. And what I hate about the streaming model from a business owner perspective is that I was able to do that. I was able to just go, I'm cutting it today. And I'm worried about the competition. And I just, people think of TV and I don't think they're really thinking of just how sweet all that advertising and those cable fees were for all those decades. And I just don't see the business model, or I don't know when things are going to get good again for people like Netflix or Warner Brothers Discovery, other than just competing the heck out of each other for content. So what are you guys' thoughts on that business model? Are you kind of unattracted to it like I am these days, or am I missing something and it's going to be a gold mine?
It's going to get worse. Definitely it's going to get worse. People are going to be struggling. There's going to be a lot more consolidation. And anyone who has long-term debt, what Discovery, Warner Brothers has, and also hopefully stronger cash flows, will be, the ones who kind of survive, make it out, do well.
Yeah, it's very competitive, even though there technically aren't that many players, like when you compare it to maybe some other industries, but they're all huge and they're all spending tons of money towards it. So that there's just kind of a race to the bottom at the moment. Feels like, I think we've mentioned it before, but it might turn into something kind of like what you see with airlines, where you kind of have a number of big players, all not really with pretty thin margins, all things considered, and just having to spend a bunch of money to keep things running
over and over, have to spend a bunch of money
right
to keep the new content coming. Yeah.
right. So maybe it might end up being very similar to that, just like at that kind of high level. Though we shall see. It's still technically a pretty new industry relative to many others.
What are your thoughts, Tom?
I think it's all just too hard for me from an investment perspective. If I had to pick one, valuation aside, it'd be Netflix. I think that's the most no-brainer. Can charge the highest price, has the least churn, has the most scale. Those are pretty good places to start.
The thing about buying
I'm
Disney,
actually most bearish on Netflix. Like, if I had to go
why
against
is that, Karan? Like, valuation aside, why is that?
So because the amount that they are continuously just going for growth, and they're going for growth at all costs. That's been the model throughout, right? It's like invest to survive. And I feel like it works as long as the numbers keep going up. The moment when, things are difficult,
now
they're going to be the first ones to get hit. Yeah.
I was really bearish when I saw that they were going to jump into advertising, because
it's desperation.
Their whole brand was, you sit back, you watch Netflix, you're paying for something quality, you're paying for it, paying up a little bit, and there's just no commercials. It was their brand, and then to just dive into ads like everybody else, and then to have to partner with someone and share money with Microsoft, I'm very bearish. But on the ones that I did not cut, Disney Plus, there's family members that really like that content, and then also I can't cut Disney Plus, or in this case ESPN Plus. I can't cut it. I watch zero ESPN, zero. I don't like anything about it. I don't watch any of it, but I pay them $5 a month or whatever it's going to be as part of the bundle, because I love the UFC. I watch many UFC pay-per-views a year, and to have the right to purchase a UFC pay-per-view for $70, you have to subscribe to ESPN Plus. And if we're subscribed to ESPN Plus, and I have people in my house that want to watch Disney, okay, then it makes sense to do the bundle. And then the other one is Amazon. I looked at cutting it because I was like, well, we don't watch it a ton, but we do watch some stuff on there. It's like $11 a month, like Amazon Prime or something like that. And we think about all the other benefits we get from it. And that's why I couldn't cut it. And so another one that's jumping in the game for yet another competitor, an article came out this week. Walmart is in the game. They're looking for a media company to partner with. So they're coming too. And I subscribe to them.
YouTube is a huge player there.
And now an article came out today. Yeah, YouTube is looking at expanding into streaming. So
what I was going to say about Disney earlier is that unlike Netflix, which is just the streaming business, when you're buying Disney, you're buying a whole lot more too, which makes it a little bit more complicated for like valuation. It's one part of multiple. So that's like an added wrinkle there. And with some of these other, like Amazon, of course, it's not just streaming. It's this very small portion compared to the whole pie. So got to consider that too. When you're buying these companies, you're not just buying one element or one streaming thing, unless it's Netflix, in which case that's the whole business.
Yeah, like with Walmart, I get groceries delivered now from Walmart Plus,
right?
And maybe they're going to put some kind of media thing into that as well. So, then Amazon bought a healthcare. They're trying to buy a health clinic company, and that might be part of Prime as well.
They bought a Roomba recently or whatever, right? Or
iRobot.
I mean, they're buying stuff all the time.
Yeah, so it's tough. And then the other thing I have with that business is what we're doing right now. We have eyeballs on us. People are spending an hour of their time watching us, and that's an hour of the time they're not watching Netflix or whatever. And the point is,
guys.
With content, it's like endless competition these days, because clearly there's no barrier to entry. rough business. It really makes me appreciate
I think
businesses that don't
Netflix
have to
was
deal with
going to
competition.
merge or get acquired at some point.
Mhm.
I think so.
Yeah,
Karan, do you
I
think there's
think
any
Netflix
chance?
has got a good shot.
Any
personally.
chance Zaslav will go after Netflix at Warner
Absolutely
Brothers?
not. Like he
Absolutely
mentioned,
not. Okay.
He's not going for streaming. So I think they're going to be directing all the streaming stuff with Amazon Prime. I think there's some deal happening.
So is Warner Brothers Discovery more of a content company?
So yeah, they're going to be focusing on like theatrical, and that's what he had said in the recent call.
Okay.
Yeah, but I do agree with Matt's comment that his compensation is ridiculous. But then again, that's after a certain share price. So the share price targets. Yeah. I think John Malone's always done that. Like he's rewarded
his model. That's part of the Outsiders book.
Yeah.
Pay the CEOs a ton with shares if they get there.
Yeah, even the new company that I'm invested in is a John Malone company. So I think his model makes a lot of sense.
The new company is a John Malone company?
That narrows it down to like only 100 companies.
The new company. Oh, then it's obviously Liberty South America.
There you go. Yeah.
Is it Liberty South America?
It is. No, Liberty Global. Yeah.
Liberty Global. Okay, because they have
So the telecom.
Oh, interesting. I know. I always see there's a lot of insider buying going on at all his companies. So
their goal is buying back 10% of them outstanding shares every year. So
we'll have to dig into that one.
Should we hit a couple questions before we wrap up here? I'll take the silence as a yes.
Definitely.
Yes,
Definitely.
let's do it.
yeah, let's go.
Wonderful. Going back here in the chat, Andrew asks thoughts on big tech. We were just talking about Netflix, which would definitely one of the FANG stocks.
I've got a thought. I'll never say big tech again, because there's businesses that are dominant and will be around 30, 100 years from now that are in my portfolio, Apple and Alphabet. And then there's businesses that offer weaker forms of advertising that don't know where they're going, and they've lost $500 billion in the last 6 months. So I don't like the mindset of grouping in companies, calling them big tech, because I like looking at it as by company basis. And so if you're going to say big tech, like some of them are thriving and some of them are completely lost.
Are you suggesting that Facebook/Meta is completely lost?
Oh, if that's the first one that comes to your mind, that's interesting.
But
I didn't say
you dropped the
anything.
$500 billion in eviscerated market cap, so I don't know what else you'd be talking about.
Yeah, it's probably that one.
Jack, how much of your portfolio is in Facebook Meta at the moment?
Let's see. I think it's still under 10%, but let me pull up the chart.
Buffett, when he was talking about Bitcoin, he said, "I don't like stepping on anybody's windpipes because I don't like when they step on mine." So I'm not trying to step on anybody's windpipes.
It's stock. It's not me, so it's fine.
Yeah, Buffett didn't mind doing it to Goldman. Like
I don't identify as a stock, so it's fine. I know some people do, and
I do. When it goes up 100% in a month, it's like that's why I'm trying to check myself.
Yeah.
100%.
Meta is 6.5% of the stock portfolio.
Sweet.
And I've been
It used
adding
to be 15 or
no, it used to be like 2. No, I didn't.
I kid.
My cost basis, I think, is like what is it actually? I think it's close to it's 193. It's been coming down.
Another mindset thing about big tech is kind of forgetting the tech aspect of it, and just again looking at these companies on a company by company basis. Because in this world, if you don't have tech inside of your business, like what are you doing? You're going to kind of go by the wayside. And even if you're an auto company, and I guess the point there is like there's always been the most modern technology of the time. But yeah, some of these companies are just on another level of success, and they're taking off again. They've had a rally in the last month.
Would Sleep Number fall under a tech company? High tech mattresses.
I got a kick.
The fact that there's chips in mattresses. Like
I was listening to your guys' episode where Tom, I think it was you when you asked Jack, can't Sleep Number just ship the mattresses without the chips? And then Jack was like, no, that's their thing. You pick the number. And I didn't know what Sleep Number was. I had always heard that name, but then I was like, oh, okay. I guess they're the ones where you put like, I want 7 incline or whatever.
Right. Yeah. Right. They popped on earnings. They kind of canceled out my Turtle Beach losses for the month. I ended up barely positive on the month. Actually 6% or so on the month, despite the horrible Turtle Beach results. So
Tom, you really messed me up, dude, with your interviews with Guy Spear. Like, speaking of like a mattress company and then like big tech, one thing I took from that interview that I'll never forget is destination analysis. And you've seen it with my portfolio, like Coupang and Carvana. I can never ever get back to the place of looking at like run of the mill businesses like mattresses or whatever, or like Seritage's real estate, and get excited about it again, because I'm so excited now by these runways with destination analysis and stuff. It's limited the amount of companies that I can even look at, which probably is a good thing. But my point is, your interview was very impactful. And also the high ground, the high economic ground I've been thinking a lot about. And a couple of those big tech companies have both of those going for them. Like the Apple car I was reading about recently. They're still trying to do it. And it's like, just think if they get that done.
Should have bought Tesla a few years back when they had the chance.
I might have these days, the way I'm thinking. I might have.
No, Apple should.
Oh, Apple should have. Maybe.
I don't know if they would have been able to. They had to
they're going for a driverless car with no steering wheel, where you all sit around in like you could do punch card in the car. That'd be cool if you all got together.
The government has to say yes to that first, which is that's its own challenge.
Mm-hmm. But yeah, I love some of those big tech companies.
Yeah.
Maybe we have one more question. One more question.
Let's do it.
We had an impassioned chat. I'm trying to find questions in it. I saw a question for you, Jason, asking about Floor and Decor. I know you mentioned that a while back. Have you done any more research on that one at all?
I just have to tell you this one. I mean, this is just tricks of the trade. I just did Command F on my keyboard and I searched the chat for question marks. And you can scroll through them real quick. And it actually worked. I was just trying that.
Huh. Oh, yeah, it actually does. I'm always afraid to do something like that because if I click on a comment,
shut it down. Yeah,
it shows it. So I'm always nervous to like do stuff like that.
Yeah, Floor and Decor. I haven't done any recent research, but they have a nice runway in terms of like, I think there's a whole lot more stores that they're going to build. And you want to talk about like businesses that have brutal competition, like streamers, and probably one day soon electric vehicles. Floor and Decor's competitive position is amazing. Like, they're competing with mom and pop shops that are going to get swallowed. And the people that could compete with them, Home Depot and Lowe's, are fat and happy. And only like 2 aisles are dedicated to flooring in those stores. And they can't grow the stores. They're fixed. So they could hypothetically like go create flooring stores and their own kind of brand, but they're not. And so they have an amazing position and they have a long runway. And the thought I had this week is I saw that over half the houses in the U.S., or maybe it's 75%, like the highest number ever, are now equity rich, meaning over 50% of the home value is in equity versus debt. And even if like new house sales drop or whatever because of interest rates and all that, people are so rich with the equity in the home that might fund a ton of remodels. Those home equity loans could fund a ton of remodels in the future to keep that company kind of growing. But I really like the company, but I just haven't been.
They had a lot of that pulled forward, I will say, in the last couple of years. So I don't know how much I'd bank into that, but to your point, I mean,
I bet there's
with our current rehab, we're using some Floor and Decor products for actually shower retiling. That's all Floor and Decor.
They've got that kind of stuff in there too in their stores.
There's one pretty close to where our house is, and right next to Home Depot, actually, or not right next to, but close to. And we've been using both, but Floor and Decor made its way in.
But the main reason I passed on it is just because I hate that industry. And like Jack, I admire you for getting in the weeds there with home remodels and all that, and then being able to unlock that value like you do, because I don't have the muscle for it, like dealing with it. And so I hate it so much, I didn't even like reading about the company, even though they're a good company. So that's mainly the reason I passed.
You just have to pretend like the money is gone, because it might be when you're putting it into something. Otherwise, mentally it's just too much to deal with, because you got to throw a lot of money around.
It'll be interesting to see what Weschler or Combs did in their 13F, because that's where I first heard about it, in Berkshire's 13F.
Any final questions?
There's one about Shinokin.
They're being taken private, right?
Yeah, they're being bought. I saw that on Twitter for like 1,700 yen or something like that, or 1,600 yen. And it was recently selling for like 900 yen or 1,000 yen. I think Monish was in that at some point, and a lot of the people online talk about that company. But yeah.
Is Monish still in it, or has he sold out?
I thought he had sold, but I'm not sure.
Yeah, I think he got out a while back. I have one last question for everyone.
Do it, Tom.
What are people reading at the moment? That's what I want to know. Anything interesting?
I've started using story graphs. I sent it to you guys in our chat a while back, but let me see if I can pull it up. But it's like a reading tracker. Someone else go first while I pull that up. What are you reading, Tom?
I'm terrible lately. I've got like 4 books on the go and haven't finished any of them.
That's what happens when you read about banks. You just get bored with reading in general, and you stop reading.
No, I finished that one. I read about half of the Snowball late last year, early this year. So I've picked that up again to try and finish that one off. That's the main one at the moment.
I'm similarly rolling with. Actually, I'm up to 5 right now, but I don't really count the Acquirer's Multiple. I only have like 10 pages of that one left. I've been meaning to do it for an episode, but I've got 4 rolling, and then story graphs, so you can show it. So you'll notice Titan here. I got like 2/3 of the way through it on my honeymoon like 2 years ago, and it's about time I finish it, or 3 years ago. It's my 3rd anniversary this week, so 3 years ago now.
Congratulations!
Thank you.
Congratulations.
I've got Titan going. I've got a very, some good, nice morning reading. Nice light read. Mount's Great Famine. Risk, which is a book a friend recommended me, and this like Enlightenment Ideas book.
900 pages, 983 pages.
Huh?
983 pages.
Yeah, it's a thick one. It's like a 5-page at a time kind of book. It's super dense, and these others, I don't want to say they're light reads, but compared to that one, anything's light.
Titan's huge as well.
Yeah, Titan's massive, but it's a lot easier to read though. It's well written. Not that the Enlightened one is poorly written. It's just super dense. Titan's more like a story, and like it's kind of easier to follow along. Just a really big one.
Karam, what are you reading?
I'm just digging into companies. Haven't been reading.
No reading, just straight into the companies.
Porsche's got the IPO coming, so that's fun reading.
I live directly next to a library here in Chicago, so I'm like trying to like get my last few like rounds out of it before I head on south. So
nice. We've got a couple super chats from Aaron.
We're killing it today with.
I think it's me.
Yeah,
I think it's you, Jason. I think it's you.
You keep coming, Jason. Aaron just throwing it down. Essays of Warren Buffett, he suggests, and also the Tao of Capital. What's that one?
What's Tao of Capital?
I haven't heard that one.
I've got a few books for you guys.
Thank you, Aaron.
Do it.
What's that, Jason?
Oh, I've got a few books. I'm reading the Complete Financial History of Berkshire Hathaway by Adam Mead.
Nice.
Really good book. And like what I found is interesting is like, even though it's so big and you would think like maybe a little repetitive, like this year they did this, that year, the next year they did that. It's really, really good and readable. And so I've been reading that. I read, and by Audible, I read half of Invent and Wander, the complete or the writings and speeches of Jeff Bezos. And what I found is that like the first half of the book, the first quarter was like super interesting, and they read a lot of the early Amazon shareholder letters, but like by the middle of the book, it was just like, and this year we're donating to the Boy Scouts of America, and just like win after win after win after win. And I was like, all right, I think I learned what I can learn from it. One of the things I learned is that his decision-making process, there's decisions, I don't know if I said this on here, but there's decisions that are reversible and decisions that are not reversible. And decisions that are reversible are low risk, and you can just do them, or risk that are reversible because you can just reverse them. But it's the ones that are irreversible. Those are the ones you have to really think about. Reading a book called The Charisma Myth, and I think it's on level with Robert Cialdini's book about forget the title, but the Cialdini book about influence, and it's really, really good. So I would recommend that for anyone interested in that stuff.
Tom, what are you reading? You mentioned
real quick.
Nishan.
This is Nishan. I mentioned Nishan's other super chat here. He's asking you.
Oh, yeah, we missed that.
Did you dig into Cardlytics?
I did a lot, and I never got there in terms of being a believer in it. Apparently, they get the e-commerce tracking from the bank. They partner with banks, and then they can get direct insights into the offers that advertisers do on their platform, and then they can report back how much their return on spend is. And it all makes sense. And the runway would be like, okay, well, if we get to X amount of users and our average revenue per user is Y, then we're going to have a huge business and a moat. Couple things always bothered me about them. One is I don't like the idea of competing with, I said at the time, Facebook, and I said that less now, but Alphabet. I don't like the idea of competing, and I'm serious about that. I used to think Facebook was more of a someone that's hard to compete with, but I don't like the idea of competing with Alphabet on advertising. And then a bigger issue is they have these bank partnerships, and you never know. Like, I guess a quarter of their revenue might come from one big bank. You never know when that contract's going to not get renewed or anything like that. And apparently some people don't worry about that, but I just never got comfortable with it. But the price is way, way down. The other thing that kind of turned me off is I saw some insider selling, and I was like, if this story is so great, then why are these guys selling? But that's the story there.
Nice.
Karan, I'll tell you what Tom's reading. He said earlier he is reading The Snowball for the second year in a row, and that's about it.
I'll give you another one. I just got to double check the title. Yeah, I'm not very far into it, but I'm also reading The Founders by I think it's Jim Sony, which is basically like a story of the origins of PayPal.
Nice.
So that's an interesting one. They had the author on the Investors podcast maybe 6 months ago, just before the book came out as well. So might be one for the list.
I'll give you guys one about Amazon because it's really helped me with my investment in Coupang. There's 2 books by, I think his name is Brad Stone. I think he's written 2 books on Amazon, but I think the one I listened to more recently was Amazon Unbound. And he kind of just breaks down all the different big things they did, things that worked, things that didn't work. And that really helped me with my investment in Coupang, because Coupang's like 10 or 15 years behind Amazon. And that's one thing I love about it, is they can look at what Amazon's wins were and what their losses were and kind of do the smart things like advertising and third-party fulfillment and all that. And so if you want to get into the history of Amazon, that's a great book.
Whoa.
There was this new book about Tencent, right? About Ponima.
It never came out, Karan.
I don't know. I saw. Oh yeah, what? But I saw somewhere on Twitter.
I bought the book about Tencent, and I pre-ordered it, and it never came. So I was like, "Give me my refund," and they did. But there is another book on him out there, on Amazon. You just search. I think if you search Ponima Tencent.
Okay.
Oh, one thing we should talk process really quick. Rob Vinall put out his letter. I believe they're public because all I did to get his letters was you register on his website with your email, and then he emails them to you. so I believe they're public. He said something in that letter that stuck with me all week. He said that he is convinced, he used the word convinced, that the investment portfolio of Tencent, and I believe that means both the public and the private investments, is one day going to be worth more than the current market capitalization. And he said that de-risked the investment because you're getting the biggest internet franchise in the world, WeChat, and the video games for free, essentially, and the cloud future for free. And whenever I had heard people talk about Alibaba and Tencent, it was, oh, well, you're going to get everything for free because you're getting cloud. Cloud is going to be bigger than the market cap one day. But this is the first time I heard someone said the investment portfolio could be bigger than the market cap. So that was like a wake-up call for me and a reminder, like, hey, we really do have something incredibly valuable here with the Process investment. Just thinking for myself, and it was a good reminder, like, think long-term and make sure you hold on to this thing because it really might be super cheap given all they have going on. But had you guys thought much about their portfolio, or is that surprising to hear? Or
yeah, I don't know Tencent very well. You guys know it a lot better than me.
Oh, I just assume every smart investor is in Process. So.
I'm not a smart investor.
Tom, you're not in Process. I didn't know Tom wasn't invested in Process.
No, I've never been in Process.
Well,
oh, okay.
We prefer the Baba pain.
Yeah.
Yeah, I prefer pain.
yeah.
Frank's in
and the drama and the drama
Process and Alibaba. Tom's just in Alibaba. Jackson, none of it. I think
Alibaba.
Alibaba.
Okay.
Yeah.
And Brad's also in both. Yeah.
Jason, did you have any thoughts on what Rob said about Carvana?
I have
he
to.
made some mistakes with.
Well, I have to reread it because I was thinking about it afterwards, and I wasn't sure what he was saying initially because it was at the end of it. I just need to reread it. But my impression was he said basically like maybe it was a mistake at that price, but now it's so cheap that he just wants to run with the potential opportunity. So he's going to hold it and see if it works out. Am I misinterpreting that, or what was your impression of his comments?
I think that's more or less on track. He may have slightly overpaid for it and also underestimated how much cash they would lose over the few months kind of after he made the investment. So they now have more debt than he thought they would have to run
believe with. On the 13F, not the current quarter Q2, because that's going to come out here on Monday, I think he hasn't put his out yet, but I think in Q1 he just drove more into it and bought like a lot more. Like the second 13F that it came out on, I think he bought a lot more. So yeah, it didn't sound like he was selling anytime soon.
Yeah, I think he was kind of at the point that it's gone down so much that he really doesn't want to sell it. He didn't mind the risk reward at those prices. But those are good letters from Rob Vanel. And
we have a question. Someone was asking about the investment thesis of Carvana, so I just wanted to get into that for 45 minutes. No, I'm kidding.
See you guys.
He can look at last week's episode.
or the is Carvana a dumpster fire from pre-earnings?
Jack, I so much appreciate you guys. This is the part of the show where I give you compliments, so you'll bring me back on, and I butter you up. But it comes from the heart. I so much enjoy coming on here because it makes me think through my investments and be able to talk about them. And recently,
that's why we do this.
I watched both episodes. I watched the dumpster fire episode where I was first on talking about Carvana, and I was watching myself kind of get the story and kind of get it, and then by the second episode, it's just interesting how much more I kind of feel like I know about the company, or how much clearer I'm seeing it for myself at least. And it was fun to go back and watch that. So thank you for having me on.
Yeah, absolutely. Thanks. We always appreciate when you come on, Jason. You've been a rock for us, so we appreciate that.
And a revenue driver. Look at tonight's.
The super chats were popping today. So like clear correlation there. Anyways, with that said, thanks everyone for stopping by, for sticking with us for an hour and almost 20 minutes. And for all the weeks before that, we very much appreciate it. Definitely like, comment, subscribe. It goes a long way towards helping the channel. And check out the links in the description below for some good stuff down there, including our Discord. Make sure to join that if you haven't already. And with that, we'll see everyone next time.
March continues.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.